Hi, and welcome to Chapter 1, The Role of Financial Manager, and this is Principles of Managerial Finance. Okay, so let's talk about a few things here. First things first, what is finance? Is finance math? No, not exclusively. Finance is really an art and a science of managing money. So the science part is finance uses a lot of mathematical properties, and logical solutions to address certain financial problems. But it also uses a fair amount of qualities that can't be quantified by mathematical measures. So when it says art, it's really talking about the intuition and experience of financial managers. So financial managers can be logical, but they can also be very creative. So at a personal level, finance is considered more with individual decisions about retirement, investing, how much earnings you want to spend, what types of savings you want to think about. So types of what to do for car loans or auto loans. So this course really isn't about personal finance, it's about corporate finance. So in a business or corporate context, finance involves, raising money for the company. And that could be raising money from investors or banks in order to fund the company's activities. It's also about how the company is going to invest their money. So looking at what we call capital in a business. So money is capital in the financial terms. So we want to see and analyze and evaluate and adjust investments in the idea of having the firm earning a profit and maximizing profits. Now, the firm needs help in deciding whether to reinvest the profits they earn in the business or maybe giving them back to investors, which we call dividends. So the managerial finance is concerned of the financial manager's duties within the corporation. So first thing we should classify, what is a firm? So a firm is a business organization that's going to sell goods or services. And they exist because investors want to access investment opportunities. They want access to generally risky investment opportunities. And that could be a low risk or a high risk, but basically they want to take their money and invest it in the firm, which is going to be, riskier than investing in a bank account, hoping for a return. Now, the firm's goal, what is the goal of the firm? And this is the theme of this course, is to maximize shareholders' wealth. So that's the goal of financial managers, is to maximize the wealth of the owners. So it's a primary goal. It's not the only goal. But the thing that financial managers always keep in the back of their head is, how do I maximize the wealth of the owners? That's my job, is to review, adjust, monitor, and invest capital so that the owners of the firm, whether it be one person or stockholders, many stockholders, is to maximize their wealth. Make all the decisions that's going to hopefully improve profits. So if it's a public company, this is going to equate to maximizing the stock price. So the stock price is really a reflection of how profitable a firm is. It's a mix of how, ideally, number one, the firm needs to be profitable, and then number two, the firm needs to be growing. So financial managers want to make sure that the firm is growing, but in a profitable way. So to maximize profits, you want the highest share price possible or the highest valuation of the company. So now the question may arise, does the profit maximization lead to the highest possible share price? Not always, because there is timing, cash flows, and risk. So when you're doing something to maximize profits, you might be making a heavy investment in a long-term operation. So shareholders might not immediately find the value in this, and the share price might not reflect it. So it's really the timing of when the profits come in. So if shareholders don't have the same confidence or vision as the financial manager, they may not incorporate that into the price of the stock. So that's why many companies may be undervalued for periods of time before the actual plans of the financial managers become more clear and there's more evidence of it working. And then it will be reflected in the stock price. So here's an example. We have Nick. It's a financial manager of Neptune Manufacturing, and they produce marine engine components. So he's choosing between two investments, a rotor and a valve. Those are mechanical parts to, say, an engine. So the following table shows the earnings per share that Nick expects from each investment over its 3-year life. So if they invest in the rotor, this would be the earnings per share over 3 years. Now, if it's the valve, this would be the earnings per share over 3 years. So here is the total earnings for the 3 years. So if Nick thought he should make the decision to maximize profits, he would recommend that the Neptune invest in the valve rather than the rotor, because here we see the valve overall generates more profits than the rotor. So it's simple as that. So deciding between two investments, which is going to generate the most earnings per share. Now, and if you look at it, the timing is important too, because in the rotor, you get more earnings earlier than in the valve, but overall total earnings is higher for the valve. Okay, so let's go back to the goal of the firm. So the goal of the firm is to maximize shareholders' wealth. And to do that, basically, you want to hopefully, if you can, increase sales prices without affecting the actual amount of sales and decrease costs. So if you can increase the price you're selling your products for and or decrease the cost it takes to manufacture the profits, that will make the firm wealthier. Now also, making investments to increase sales on their own is helpful too for economies of scales and helping to spread out those fixed costs over more products and more sales. And those require, generally investments in advertising and marketing and brand development. But again, that's also something that the financial manager is involved in. The financial manager is involved in all aspects of the company. Research development, sales, production, advertising and marketing. They're going to be working with these managers to set budgets, confirm results. So the financial managers in the company involved in all aspects. It's generally thought of as a pretty strong position right behind the CEO or president of the company. So now here is some suggested balance in consideration of the welfare of the shareholders and other firm stakeholders. So when you're maximizing shareholders' wealth, you have to also think about maximizing the shareholders' welfare. So, of course, you have maximizing the shareholders' welfare is really about increasing earnings per share. But what about the stakeholders? How do you maximize the stakeholders' welfare? Well, basically, this is about taking care of your employees, your suppliers, and your customers. So even though they're not stockholders and they're not owners, they're still going to be valuable partners to the company. And members of the local community should be included. So how do you do this? How do you also maximize stakeholders' welfare while keeping shareholders' profit maximization up? Well, sometimes you might have to lose a little bit of profit or spend a little profit to give employees better benefits, better salaries. But you'll get, in return, theoretically, you'll get employees that are more loyal, stay longer, more highly productive. You can also invest in employees by giving them training, providing them tuition reimbursement, and this makes for a more valuable set. So you're basically taking some of the profits today to invest in your employees and make your workforce more profitable to you. And it's the same thing when you treat suppliers. You want to treat suppliers with respect and fairness. And it's most especially important for customers. You really want customers. You want to show that you're valuing your customers, you're respecting your customers, and you're giving your customers what they want, even when that you may take from profits in the short term to keep customers happy, but in the long term, it will produce better sales. This is a key example of this is when companies start to shift their return policy. Say, just take companies like Costco, Kohl's. They're known for very generous return policies. Home Depot, Costco, I think, are pretty generous in their return policy. And they do this, instead of scrutinize the return and scrutinize the customer, they're very lenient on the return. And this is so that they keep the customer happy, because they know that if a customer wants to return a product and it's denied, they may not shop there anymore. So if you look at the overall dollars and cents, okay, we're going to accept this return, even though the customer doesn't have a really good case for the return. But no questions asked, we'll accept it because we know the future purchases the customer makes will more than pay for this return. So there's an idea of how you may invest in your customers in that way. Now, local communities as well. You don't want to be a company that's abusing your local community or taking advantage of the local community. You want to give back and support the local community, and then hopefully the local community will support your business more. Okay, now let's go back to maximizing stakeholders' welfare. So flaws in neglecting a shareholder's wealth maximization. So maximizing shareholders' wealth does not in any way imply that managers should ignore the interests of everybody connected to the firm, just like I was saying before. So if someone is not a shareholder, it doesn't mean you neglect them. So you want to, in order to maximize the shareholders' value, managers have to think about long-term consequences of their actions, how they would affect customers, local communities, suppliers, employees. So the stakeholder perspective is a big part of the financial manager's concern. So it's not just about of course, maximizing shareholders' wealth is their number one priority, but close behind that is also taking care of the stakeholders. Now it's often difficult to implement and difficult for managers to consider stakeholders' interest in a lot of decisions. But it's still definitely going to lead to more successes for the company if they keep the other people, the stakeholders involved in the company, happy, as well as the shareholders. Now, if you neglect the shareholders, then this could be a problem too. So don't misinterpret the statement that managers should maximize shareholders' wealth as implying that managers should take any action, including illegal or unethical actions, to increase the stock price. This is not what we're saying here. So if we want to maximize the shareholders' wealth, it can't be at the expense of the stakeholder. And if we want to maximize the shareholders' wealth, the company has to be ethical and has to do everything legally and follow all the regulations of the company. So when financial managers do take shortcuts, cheat, do things that are illegal, make unethical actions, generally it comes back to bite the company in the ass and cost them much more than they may have saved. So today's financial manager is expected to operate in their pursuit of maximizing shareholders' wealth, in pursuit of maximizing stakeholders' wealth in a very ethical and socially responsible way. So speaking of business ethics, the business ethics, as you've known for other courses, is basically a standard of conduct or moral judgment that's applied to everybody involved in the business. So the goal of these ethical decisions or standards is to motivate businesses and make participants adhere to the letter of the spirit and the law and regulations concerning a business and the professional practice. So if you're not ethical and you're operating in a business as a financial manager, you will probably most definitely be more destructive to earnings and profit maximization than if you're ethical. Being ethical really is a way of, in the long term, promoting the company's values and increasing the trust in the company, whether it be trust of the employees, trust of the shareholders, trust of the government, and overall reputation will be much more valuable than any temporary shortcuts to profits that you might find in an unethical or illegal way. So just come from that standpoint that any unethical or illegal behavior is just not something any financial manager should engage in any way. So as far as ethical guidelines, we have to think about, let's look about 4 different things. Is the action arbitrary or capricious? So does it unfairly single out an individual group or people? So the idea is, if the company makes a decision, is that going to be some way unethical or unfair to any particular individual or any particular group of people? Number 2, as an ethical guideline, does the action violate the moral or legal rights of any individual or group? Does the action conform to accepted moral standards of the day? Are there alternative courses of action that are less likely to cause actual or potential harm? So this is the basic 4 questions you should ask yourself before making any decisions as a financial manager. Now, looking at ethics and share price. So if you have an effective ethical platform, ethical program that's going to enhance the corporate value by producing positive benefits. So ethical behavior can be used for achieving the goal of maximizing the owner's wealth. And that's by, you save yourself a whole lot of legal trouble, and also, including lawsuits, by being ethical and following a moral conduct as a business. So let's look at the managerial finance function. So we're going to go back to straight managerial finance. Now that we got that sort of established that ground base of ethics and the ground base of how financial managers need to look at stakeholders as well as shareholders. So now we can move forward to things that a financial manager is going to do on a daily basis. 1, make investment decisions. 2, review capital budgeting decisions. 3, financing decisions. So the financing decisions are going to become in 2 parts. Capital structure decisions, money that they're going to raise to enhance the activities of the firm, and working capital decisions. Decisions that refer to the management of the firm's short-term resources like cash and inventory. So here's basically, if we look at the balance sheet, we want to make investment decisions which are going to require some financial decisions. So when we look at financial decisions, is how do we manage our current liabilities and our long-term funds? And as far as investment decisions, how do we use these current liabilities and long-term funds to buy fixed assets or organize our current assets? So these are things that financial managers can be involved in as far as the balance sheet's concerned. Now, principles that guide the managerial decisions is, and this is all things we're going to learn in this course, is the time value of money. Very important to understand how money changes through time, especially making decisions as investments or in capital budgets. The trade-off between risk and return. Understanding the trade-off a company makes when they make an investment decisions and looking at the risk of this investment as opposed to the return. Understanding that cash is king. Companies with cash is the oil in the engine of a company. If the cash runs out, the company, just like an engine, would seize without oil. And competitive financial markets. Understanding the financial markets and how to raise capital in a competitive way in these financial markets, which would be, the bond market, the stock market. Now, let's look at some principles that guide the manager's decisions. So, incentives are important. So, managers' incentives are not just properly aligned with the interests of the shareholders. So, because managers are people too, and they have their own personal incentives and their own personal goals. So sometimes it's not always 100% aligned with what's best for the shareholders. So this is not how a financial manager should act. A financial manager should, number 1, do what's best for the shareholders before considering their individual concerns. So we have this principal and agent problem where, it arises from the owners of the firm and its managers who are not the same people. So the owners of the firm, of course, are always going to do what's best in their own best interest, but typically owners don't have the skill or the capacity to run a company financially. So financial managers are who will be the agent and the owners will be the principal. So they're not the same people in most cases. Now, so the agent does not act in the interest of the principal. This could be a problem. So in just talking about this, for example, the financial manager has a choice between 3 different companies to provide heating oil for the business. And they spend a lot of money in heating oil because they have multiple buildings that need to be heated. And they don't choose the supplier with the lowest price. Instead, they personally select a supplier that has a higher price because they promise to fill their home heating oil tank for free. So there's an example where they chose basically a kickback and picked the more expensive supplier over the cheaper supplier because it benefits themselves. So that's an example of a principal agency problem. Now, if we talk about let's go back to the managerial finance function. So we have the organization of the finance function. So basically you have the CEO, Chief Executive Officer, sort of like the president of the company, and then the CFO. Now, the president or CEO of the company is the most powerful figure in the company, but the CFO is the second most powerful because they control the money. Nobody else, none of the other officers can do anything unless it's funded by the finance department. And in the finance department, we have Treasury, the controller, which is an accounting function, Director of Investor Relations, Director of Internal Audit, and Foreign Exchange Manager, just to name a few positions. So if we look at an overall chart here, so how an organization is organized, we have the shareholders, and they elect the board of directors. So these are all the people that own the stock. They elect the board of directors, and the board of directors is going to hire the president or CEO of the company. And then the CEO is going to hire a number of vice presidents or operating officers. You know, the operational officer, human resources officer, marketing officer, and chief technology officer, plus the chief financial officer. So the chief financial officer, they're the one controlling the budget or the money for marketing, for technology, for operations, for human resources. So these other 4 can't really do anything unless the financial manager, officer, chief financial officer agrees and provides them with funding. So in order to manage the company, the chief financial officer has these 4 positions we talked about earlier. So if you're the controller, of course, you're going to hire a cost accountant, a financial manager, assistant controller, and the senior manager of financial planning and analysis. You're also going to have a director of internal audit, which is generally, a smaller department, as well as investor relations. The treasurer is going to have a director of tax, a cash manager, a foreign exchange manager, director of risk management, assistant treasurer. So this is a number of positions all reporting to the CFO, who in return reports to the president, who in turn reports to the board of directors. Now, let's talk about the relationship to economics. So there's an economic principle that states that financial decisions should be made and actions taken only when the marginal benefit exceeds the marginal costs. So that's a very key concept. You want the benefits to exceed the costs. Now, in the relationship to accounting, there's an accrual basis, which is going to recognize the revenues at the time of the sale and then recognize expenses when they occurred. And there's also a cash basis, which recognizes revenues and expenses only with respect to actual inflows and outflows of cash. So the accrual basis and the cash basis, 2 different emphases on cash flow. And now, as far as the relationship to accounting, remember the financial manager is in charge of the accounting department. And as far as decision making, accountants devote most of their time and attention to collection, organization, and presentation of financial data. Financial managers, in turn, they evaluate the accounting statements, they develop additional data, they do data analysis, they make decisions based on their assessments of the associated risks and returns. So this is why finance, to me, is a more interesting and more fulfilling career, because accountants basically, they're just sort of doing a very routine, formulaic organization of the financial statements, the debits and credits, recording all the transactions of the company, which is a detailed type of work and it's difficult work. Now, the financial managers, though, it's a little bit interesting because the financial managers get to be creative and they get to be analysts, and they think about the data that the accountants provide them and figure out how can they use this data to evaluate the company's performance and suggest investments and to propel the company forward. So the decision making and the strategy is more with the financial managers and less with accountants. Although, to be fair, most financial managers were previously accountants. And that's how I started out too. I was an accountant and then later became a financial manager. And I was a more powerful financial manager because I understood accounting very well. And accounting is sort of like the language of financial decisions, or the language that financial managers use to create the strategy to propel the company forward with maximizing shareholders' wealth. So if you're thinking of, so I kind of look at it like this, I would explain it to students like this. It's sort of like doing laundry. The accountants, take in all of the dirty clothes, they wash the clothes, then they dry the clothes and they fold the clothes and they put them away in specific compartments in the dressers, drawers and closets. And then they just repeat this process every week, every month. The financial managers would be the ones to come in and look at the clothes and say, okay, these clothes should be donated, new clothes should be purchased, the clothes should be, if the clothes are organized in this way, it would produce better results, make it easier for people to get dressed. So just explaining the process in a more, a lower level type of explanation, which would just be about clothes management. Accountants wash the clothes and the financial managers organize and make decisions based on the investment of the clothes. Okay, let's talk about legal forms of business. So we're going to talk, there's many legal forms of business. So we're going to talk about the biggest legal forms of business. So we have a sole proprietorship. Most common form of business. This is operated by one person for his or her own profit. Now, as a sole proprietorship, the risk is you are going to be assuming all of the liability related to this business, which could also bleed into your personal liability of your personal assets. So you are the person who are making all the decisions and you get to absorb all the profits or all the losses. Now, a partnership is when more than one person gets together and they form a partnership. And the idea being that two heads are better than one, sort of. Or, the more people you bring in, the more skills you can bring in, the more capital you can bring in. So a partnership is a little bit more complicated. So it's an article of partnership has to be written, a contract to establish the business partnership and what each individual in the business partnership is responsible for and percentage of ownership. Now, corporations are another legal form, but these are typically for bigger companies. And what it does is the corporation is an artificial person. So now with the sole proprietorship and the partnership, liability is going to be directly tied to the partners. But with the corporation, liability is tied to the corporation. So the business, entity is going to have a legally distinct artificial person. So it's going to have similar duties to a partnership or sole proprietorship, but corporations create like an artificial person who is going to be legally distinct from the owners. So if someone files a lawsuit, it's against the corporation, not the owners of the corporation. So the corporation, where if someone files a lawsuit in a partnership or a sole proprietorship, they can reach beyond their business and attack their personal assets. With a corporation, these lawsuits can only attack the corporation's assets and never the assets of the shareholders. So a stockholder or shareholder, they do own a corporation and they have equity in the form of common stock and sometimes preferred stock. The limited liability is what really sets the corporations out different from partnerships and sole proprietorships. So the corporation's debt and the amount that is invested in the firm is limited only to the assets of the company. Now, So for corporation, stock is what represents the ownership in a corporation. Dividends is how a corporation can pay out, distribute cash to shareholders. And the board of directors are who is elected by the stockholders to represent them and be responsible for running the company at a very high level, setting policies, approving major decisions and strategic goals of the company. Now, the corporations will hire a president or chief executive officer, and they're going to be responsible for managing the firm's day-to-day operations and carrying out the policies established by the board of directors, which we just talked about earlier. So here is just another review. So the strength of the sole proprietorship is the single owner receives all the profits. It's very low organizational cost to set up and run. The income is taxed at the sole proprietor's personal tax return. So the sole proprietorship doesn't pay taxes. It's all incomes passed to the individual. It's independent. You can have a lot of secrecy, and you can easily end the company, end the business. A partnership, you could raise more funds because you have more partners, so your credit is bigger. You could have more brain power skills added to the partnership because there's more people involved. And the income is also included on each partner's personal tax return. So the corporation, their biggest asset is limited liability. So you cannot lose more than you invest in a corporation. And corporations can get bigger very quickly. So they have access to more capital. And it's very easy to transfer the ownership of the company by trading or selling the stock. And the life of the corporation is forever. So the life of a partnership is as long as the person who owns it. The life of a sole proprietorship is as long as the person lives who owns it. The partnership is as long as one of the partners lives. As soon as the partner dies, then the partnership is dissolved. It could become a sole proprietorship or become another partnership. But corporations, since they're artificial person, they live forever. And you can hire professional managers and has better access to financing. Now, the weaknesses of the sole proprietorship is that you have unlimited liability. So that's a weakness for the proprietorship and the partnership. You can be sued and they can take your entire business and everything you own. For the sole proprietorship, you have a limited ability to raise funds. You have to be, as a sole proprietor, jack of all trades and really function in multiple roles. It's difficult to really give employees long run career opportunities or have the economies of scale to really offer employees benefits and things like that. As soon as you die, the proprietorship's over. With a partnership, this dissolves when the partner dies, which is a liability, and it's difficult to liquidate or transfer ownership of the partnership. But with a corporation, the weaknesses are you're taxed higher because the corporation pays tax, and then any dividends sent to you as an owner, you pay tax on them too. So it's called double taxation. It's more expensive and complicated to set up than a partnership or a sole proprietorship. More government regulations, and there's really a lack of secrecy because corporations have to provide and disclose financial results. So sole proprietorship is the largest form of business in the United States, followed by partnerships and then corporations. So but sole proprietorships, even though it's the majority of businesses, they provide a smaller amount of total income. In total, sole proprietorships account for almost 3/4 of the number of businesses, but they own only 10% of the business income. So if we look at this slide, next slide here, you see that sole proprietorship is 25% of 25 million or 73% of all businesses. Partnerships are 10%, corporations are 17%. As far as total income, partnerships generate only 10%, partnerships 26%, sole proprietorships 10%, partnerships 26%, corporations generate 64% of all business income. So even though there's a lot of sole proprietorships, it's really the corporations who provide most of the business income in the economy. So business organizations, how they're formed and how they're taxed. So owners pass-through businesses such as sole proprietorships and partnerships pay tax at your individual level. So it's not the business does not pay tax. So there's marginal versus average tax. This is a concept that you should know. So the marginal tax rate represents your highest tax rate, or the tax rate at which your next dollar of your income will be taxed at. While the average tax rate is just your average percentage of taxes paid. Since we have a progressive system, it's really just averaging the total money you pay in taxes by your total income. Now, double taxation occurs for corporations because the corporation pays the tax, and then individuals who receive a dividend are going to pay tax on that dividend as well as a shareholder. So then there's ordinary income versus capital gains. So ordinary income is earned through the sale of goods and services, while capital gains is income earned through selling an asset at a higher price than it was purchased at. So if a corporation buys a building for $1 million and sells it for $3 million, they have $2 million of capital gains they have to pay for. Okay, so other things to think about as far as legal forms of business, there are other legal liability organizations. There's limited partnerships, S-corps, limited liability companies, and limited liability partnerships. They're really nuts and bolts of these types of partnerships are out of scope of this course. But this is what I was saying before this. There are other, we covered the big three main types of business forms, but these other forms of business exist too, and they're sort of hybrids that exist between the three major forms of business. Now let's move into agency problems and agency costs. So this is the cost that shareholders bear when managers pursue their own interests. So we kind of touched upon this earlier. Now, what we don't want is people who pursue their own private interests and don't really benefit the company's interests. So this is somehow a system has to be set up to monitor these agency problems of managers in the company to make sure that there's a double check on them, that what they're doing is for the benefit of the company and not themselves. So to help with this, the corporation will have what's called corporate governance. So the corporation will lay out the rules, the processes, the laws by which the company is going to operate, be controlled, and be regulated. So there's internal corporate governance mechanisms. So we do have stock options, which securities allow managers to buy shares of stock at a fixed price. And we have restricted stock, which is shares of stock is paid out as part of a compensation package that don't fully transfer from the company to the employee until certain conditions are met. So why do we have stock options and restricted stock as part of the corporate governance mechanisms? Well, this is to encourage financial managers to have ownership in the company. And the idea is if the financial managers have stock options or restricted stock, that they'll be rewarded if they make the proper actions to increase the stock price of the company. So this is supposed to keep managers focused, particularly financial managers focused on maximizing shareholders' wealth and maximizing stock prices, because they're treated like, since they have access to stock, special type of stock or stock options that will only be valuable to them if the stock price is higher in the future. This will guide their direction or the decisions to be more in line with the corporation's shareholders. Now, as far as external corporate governance mechanisms, we have individual versus institutional investors. So we have these activist investors who specialize in influencing management. So if a big investor like Carl Icahn sees that a company is being mismanaged and the share price is suffering, they may come in, take over a large portion of shares, buy a large portion of shares of the company, and become an activist, which they'll try to get elected to the board of the company. They'll try to pressure and make the company, try to influence the company's decisions as a large shareholder. In some cases, there could be a threat of a takeover where the company will be taken over by its shareholders and the management fired because they'll feel the management's incompetent. Now, because of a large number of government regulations that were imposed since the year 2000, specifically the Sarbanes-Oxley Act of 2002, this was a result of companies doing bad things in the 1990s and early 2000s, where they lied, they cheated, they misrepresented, they colluded, they had all sorts of agency problems that affected the stock market. And there was a lot of stock value that went down because of this fraudulent activity. So the Sarbanes-Oxley Act of 2002 was aimed at eliminating corporate disclosure and conflict of interest problems. So this was a way of making companies more transparent, making financial managers more responsible, and it contained provisions concerning corporate financial disclosure, the relationship between corporations, analysts, auditors, attorneys, directors, officers, and shareholders. Basically, a new set of laws and regulations to force a company to be more transparent and to really define what is acceptable, what's not acceptable, and ways to audit and track and review management's decisions. Okay, so this is the end of Chapter 1 of Finance. Look for the Excel, Chapter 1, Excel for Finance, where I'm going to review more of the quantitative aspects of this chapter and show you how to calculate these quantitative concepts in this chapter through Excel. And this is important because Excel is what businesses use. And the more skilled you are at Excel, the more familiar you are with solving problems in Excel, the more useful you would be as a financial manager to businesses. Okay, have a great day, and I'll talk to you soon.